Welcome back to your daily Bitcoin and digital asset intelligence briefing. And looking at the charts this morning, we know you rely on this deep dive to cut through the noise because the amount of data we've had to process over the last 24 hours is just staggering.
It really is. Between yesterday, March 4th, and today, March 5th, 2026, we are watching the market undergo a profound rewiring. Like, the actual architecture of the ecosystem is shifting right beneath our feet.
Exactly. And our mission today is to give you, the listener, the comprehensive blueprint of that shift. We've got a massive agenda. We're looking at an aggressive spot market resurgence, some truly historic changes to the U.S. banking plumbing, a severe contraction in venture capital paired with this wild mining arms race.
Right, and don't forget the legislative side.
Yeah, the stalled legislation in Washington. And then capping it all off, a geopolitical shockwave that is fundamentally altering the macroeconomic baseline.
It's a heavy stack of intel today, but it all connects in ways that are crucial for understanding where capital is flowing across the globe, and more importantly, why it is flowing there.
Now, before we jump in, a really important caveat for you. Today's briefing is going to cover some intense political lobbying and highly sensitive geopolitical conflicts.
Yeah, it gets a bit heavy.
It does. So we want to be explicitly clear right up front. We are maintaining an entirely neutral stance. Our goal here is not to endorse any specific side, policy, or military action.
Exactly. We are looking at the mechanics and the math. We're purely unpacking the factual implications these events have on the global financial markets and the digital asset landscape. We leave the politics at the door.
Okay, let's unpack this. Starting with the intraday market action. Over the last day, we saw a massive move up in the Bitcoin spot market, an 8.4% surge, hitting an intraday peak of $74,100 before settling into a high-range consolidation around $72,600 this morning.
Which is a massive technical breakout.
Right. And when we see a jump like that, the immediate assumption is often that, everyday retail investors are suddenly rushing back in with massive FOMO. But is that what the data actually shows?
No, the forensic analysis of the order flow points in the exact opposite direction, actually. This was aggressive, algorithmic spot accumulation by institutional custodians.
But wait, I'm looking at the derivatives data, and perpetual futures open interest went up. So doesn't that mean directional speculators are just using leverage to front-run the rally? How do we know this isn't a speculative bubble?
That's a great question. You have to look at the funding rates. Even though open interest went up, the funding rates across offshore derivative exchanges remained completely neutral.
Which means what exactly for the baseline price?
It tells us the foundation of this price appreciation is physical spot absorption. In a leverage-driven bubble, the cost to hold those long derivative positions skyrockets. That gives you a high funding rate.
Right, because everyone is borrowing to go long.
Exactly. So when the funding rate stays neutral despite the price going up 8.4%, it means the big players are buying the actual physical asset. The derivatives are just noise in this case. The spot buying is the true signal.
And it looks like a massive portion of that spot buying is flowing straight through the ETFs. We just witnessed the end of that agonizing $8.9 billion drawdown that paralyzed everything in late February.
Yeah, that was a brutal stretch.
It was. But it didn't just slowly taper off. It completely reversed into a $1.1 billion V-shaped recovery over just 3 days. Looking specifically at yesterday, March 4th, the aggregate U.S. spot Bitcoin ETF saw $461.9 million in net inflows.
With BlackRock doing the heavy lifting again.
Yeah, BlackRock's IBIT alone observed $306.6 million that total.
And what's fascinating here is the cost basis of these institutional allocators. When quantitative analysts look at the average realized price for the aggregate cohort of ETF holders right now, it sits at approximately $79,000.
Go on. $79,000. Okay. But the asset is currently trading in the $72,000 range.
Correct.
So the majority of the institutional capital deployed before that late February correction is mathematically underwater. They're literally losing money on paper. Why on earth would they allocate another $500 million yesterday?
Because that tells you everything you need to know about how traditional finance views this asset today. They aren't panicking. They certainly aren't capitulating. They are doing what institutions do with high conviction assets. They are averaging down.
So they view $72,000 as a structural discount.
Exactly. They're treating Bitcoin as a mandatory long-term portfolio constituent. And there's a mechanical reality to this inflow as well, tied to standard T+1 and T+2 settlement rules.
Let's translate that for a second, because financial plumbing can get a bit dense. What do those settlement rules actually force the market to do?
Well, T+1 and T+2 just refer to the trade date plus 1 or 2 days for the transaction to officially settle. So that $461 million that flowed into the ETFs yesterday acts as an inelastic, price-agnostic vacuum on the secondary market over the following 48 hours.
Meaning the authorized participants managing these ETFs literally have to go into the market and buy the physical Bitcoin to back those newly created shares.
Right. They don't care what the price is. They are mathematically forced to buy it. And that creates a massive buffer that artificially suppresses downward volatility.
So we have Wall Street forced to vacuum up the supply. That is a massive paradigm shift. But the public-facing ETF market is really just the tip of the iceberg here. Behind the scenes, the actual plumbing of the sovereign financial system is being completely rewired.
Which brings us to Kraken.
Yes, Kraken Financial. They are structured as a Wyoming Special Purpose Depository Institution, or an SPDI. And yesterday, the Federal Reserve Bank of Kansas City officially granted them a master account. How big of a deal is this?
It's history being made. I mean, this is the first time a digital asset-focused bank has gained direct, unimpeded access to the Federal Reserve's core payment infrastructure. That includes the Fedwire network.
Which is huge, because for years, crypto firms had to rely on this fragile, opaque web of commercial correspondent banks just to settle fiat transactions.
Right, and if that commercial bank suddenly decided they didn't like crypto, or if the bank itself collapsed, the crypto firm was left completely stranded. They had no ability to move dollars.
But with a Fed master account, that dependency vanishes. Kraken can now clear and settle U.S. dollars instantly, directly on the sovereign rails. However, I'm looking at the details here, and the Fed gave them a Tier 3, or skinny account. What are they missing out on with a Tier 3 designation?
It is highly tailored. Kraken gets the instant fiat settlement, but they are denied the privileges of a traditional bank. They earn zero interest on their overnight reserves held at the Fed, and they have absolutely no access to the Fed's discount window.
The discount window being the Fed's emergency pawn shop for traditional banks, essentially.
That is a great way to picture it. If a traditional bank faces a sudden run on deposits, they can go to the discount window, hand over their assets as collateral, and get immediate emergency cash. Kraken doesn't get that safety net.
Even without that safety net, the legacy banking lobby went absolutely ballistic over this approval. Hours after the news broke, the Bank Policy Institute and the Independent Community Bankers of America issued coordinated public condemnations.
They really did not hold back.
No, they didn't. They cited massive systemic risk and anti-money laundering vulnerabilities, arguing these accounts should only ever go to federally insured institutions. Why are traditional banks so terrified of a skinny account?
You have to look at the structural threat to their business model. Kraken Financial operates on a strict full reserve model. They are legally mandated to hold liquid assets equal to or greater than 100% of customer deposits.
Whereas traditional banks operate on a fractional reserve model. They take your deposit, keep a tiny fraction in the vault, and lend the rest out to make a profit.
Exactly. So if a full reserve digital bank can suddenly offer real-time fiat settlement directly integrated with crypto trading without any of the inherent risks of fractional lending, the traditional banking model faces a severe existential competitive threat.
And Kraken isn't the only one bypassing the old system. Zero Hash, which provides massive back-end infrastructure for companies like Stripe and Franklin Templeton, just applied to the OCC for a national trust bank charter.
This is a classic, highly effective regulatory arbitrage strategy. Right now, to operate nationally in the U.S., crypto firms have to navigate 51 different state money transmitter licenses.
It's an administrative nightmare. Conflicting rules, endless audits.
Total nightmare. By securing an OCC charter, Zero Hash gets what is called federal preemption.
Meaning one federal rule to rule them all, overriding the state-level labyrinth.
That is the goal. They escape the state-level red tape and operate purely as a federally regulated fiduciary. They won't take retail deposits or lend money. They will just handle institutional custody, staking operations, and stablecoin management. It aligns perfectly with the new Genius Act framework rolling out in Washington.
And here's where it gets really interesting. Because as the infrastructure matures, so do the big Wall Street players utilizing it. Morgan Stanley just updated the architecture for their proposed Bitcoin ETF, and they are implementing a dual custodian model.
Yeah, this is a massive shift in how these funds are built.
They've chosen Coinbase custody to handle the digital side, but they contracted BNY Mellon to handle the cash side. Why go through the headache of using two different massive custodians for one fund?
This is the ultimate maturation signal for Wall Street risk models. Coinbase handles the offline cold storage cryptography. They keep the private keys completely disconnected from network vulnerabilities.
While BNY Mellon acts as the fund administrator and cash custodian.
Right. Legacy finance has zero tolerance for commingling assets. By strictly separating the custody of the digital bearer asset from the management of the fiat cash flows, Morgan Stanley sanitizes the product. They were injecting a systemically critical institution like BNY Mellon into the accounting pipeline to satisfy the most conservative, risk-averse portfolios on the planet.
So Wall Street is building this incredibly safe, conservative, government-approved pipeline for Bitcoin. But if we look at the other end of the risk spectrum, the Wild West of venture capital, the money is actually drying up.
It is a totally different story over there.
Andreessen Horowitz, or A16, say, just initiated fundraising for their Crypto Fund 5, targeting $2 billion. Now, $2 billion sounds massive, but contextualize that for us.
For a firm like A16's, that is actually a 55% drop from their 2022 fund, and it reflects a grim reality in the broader VC market. We have seen aggregate crypto venture funding collapse from $86 billion in 2022 down to just $7.95 billion in 2024.
That is a staggering drop, and deal velocity in Q1 completely evaporated, right? Dropping from 724 deals to a mere 97.
Yes.
What turned off the spigot so aggressively?
The global central banks. When limited partners think massive university endowments and state pension funds, when they can get a high risk-free return on sovereign debt, they abandon highly illiquid speculative tokens.
Right. If you can get paid 5% to take zero risk buying government bonds, you aren't going to gamble on an unproven crypto startup.
Exactly. The easy money era is over. So the venture capital that remains is hyper-concentrating strictly on foundational infrastructure and the convergence of decentralized networks with artificial intelligence.
Which brings us to a fascinating paradox in the mining sector. We have American Bitcoin Corp, or ABTC. They just reported a catastrophic $59.5 million loss for Q4 2025.
A brutal quarter for them on paper.
They noted it was mostly from non-cash fair value adjustments on their treasury. To start, what does that actually mean for their balance sheet?
A non-cash fair value adjustment just means the value of the Bitcoin they hold in reserve dropped during that quarter, so they have to report it as a loss on paper. It doesn't mean they actually burn through $59 million in cash operations.
But the market punished them regardless. Their shares collapsed, trading at just 93 cents.
Right, they are basically a penny stock right now.
But then, right after the earnings blackout period lifted, ABTC board members Justin Mateen and Richard Bush stepped in and bought 1.63 million shares of their own company's stock. Why double down on a company whose stock is getting hammered?
Because they are playing a thermodynamic arms race, and they believe they are holding the winning hand. Right now, global network difficulty is sitting at a rigid 144.40 terahashes, and hash price, the actual revenue a miner earns per calculation, is severely compressed at roughly 3 cents per terahash.
So it is harder than ever to mine a Bitcoin, and you get paid less for doing it.
It is a brutal margin squeeze. But these insiders know they are about to plug in 11,298 new generation ASIC miners this month.
So they are front-running their own fleet expansion. What makes these new machines so special?
They are adding 3.05 exahashes per second of massive scale, operating at an elite energy efficiency of 13.5 to 16.0 joules per terahash.
To put that in perspective for you listening, joules per terahash is basically the fuel efficiency of the mining machine, how much electricity it takes to do the math.
Exactly. In a market where competitors like CleanSpark are aiming for a massive 50 exahashes of total power, scale, and cheap electricity are your only means of survival, ABTC insiders are betting their new, highly fuel-efficient fleet will allow them to survive the margin squeeze and outcompete the rest of the network.
So what does this all mean? We have ETF capital flowing in, traditional infrastructure tightening up, miners fighting for thermodynamic survival. But in Washington, the legislative gears have completely ground to a halt. The Clarity Act, which is the broader digital asset market structure bill, is officially stalled.
And the entire fight revolves around stablecoins and yield.
Walk us through the two sides of this fundamental dispute.
On one side, you have the traditional financial lobby, heavily echoed by JP Morgan's Jamie Dimon. Their argument is straightforward. If a stablecoin platform holds dollar balances for users and pays them interest on those balances, it is walking and talking like a bank, and therefore must be subjected to traditional fractional reserve banking regulations.
But on the other side, Patrick Witt, the executive director of the President's Council of Advisors for Digital Assets, pushed back on that premise completely. He stated that the recently enacted Genius Act explicitly forbids stablecoin issuers from lending out their underlying dollar reserves.
And that is the crux of the counter-argument. Witt is pointing out that because those reserves cannot be legally lent out to borrowers, there is zero systemic credit risk. The catastrophic risk that traditional banking regulations are specifically designed to prevent literally does not exist in the stablecoin model.
If the reserves are sitting there 100% backed and there is no credit risk, why did the American Bankers Association reject the White House's proposed compromise? What are they actually afraid of?
They are terrified of deposit flight. Standard Chartered put out an estimate recently that sent shockwaves through traditional commercial lenders. If frictionless stablecoin yields become entirely legal, meaning you or I can hold a digital dollar on our phone and easily earn a high treasury yield, it could drain $500 billion in foundational deposits from the traditional banking system by 2028.
That makes total sense. Why would anyone leave their money in a traditional savings account earning a fraction of a percent when a stablecoin app pays 5% with no lockup?
Exactly. The banks aren't worried about systemic risk. They are trying to protect their own deposit base from a superior product.
And that protectionist fear has brought the entire Clarity Act to a standstill. Now, we need to transition to the macroeconomic data and, subsequently, the geopolitical developments that are acting as the ultimate catalyst for everything we've discussed today. Again, maintaining our entirely neutral lens on this, the economic data from this morning presents a highly restrictive scenario.
Yes, the labor numbers are really dictating the macro environment right now.
Initial jobless claims came in at 212,000, lower than the expected 215,000. Furthermore, continuing claims hit a 10-month low of 1,873,000. What does this robust labor data actually signal to the Federal Reserve?
If we connect this to the bigger picture, this data tells us the labor market refuses to fracture. Employers are hoarding labor. We are in a low-firing environment. And while that sounds great for the everyday worker seeking job security, for the Federal Reserve fighting inflation, it is a nightmare.
Because it creates wage push inflation.
Precisely. When companies hoard workers, they have to keep wages high to retain them, and those higher wages keep prices elevated across the economy. The Fed is entirely trapped. They have no mathematical justification to cut interest rates right now.
Which brings us to the severe geopolitical shockwave. The U.S. Central Command just released their assessment of the first 100 hours of Operation Epic Fury against Iran. We are strictly looking at the operational facts of the conflict here. 2,000 precision-guided strikes have been executed. 20 Iranian naval vessels have been sunk, including the frigate Iris Dana in the Indian Ocean.
The scale of the operation is immense, and Iranian ballistic missile and drone deployments have been reduced by over 70%.
But the degradation of that centralized military infrastructure has triggered a highly unpredictable asymmetric response. The theater of conflict is not remaining localized. It is expanding rapidly across borders.
Yes, the contagion is already manifesting. International reporting confirms that Iranian-origin drones struck civilian targets in Nakhchivan, Azerbaijan.
Which is a massive escalation. That included an international airport terminal and a civilian school. The geographical expansion here is critical because a retaliatory action by Azerbaijan severely threatens to pull NATO-aligned Turkey directly into the conflict.
It is a powder keg.
How does a kinetic war of this expanding magnitude connect back to the financial data and your portfolio?
The connection lies in the sheer cost of sustaining global military operations. The U.S. command is actively seeking staffing and resources to sustain a 100-day campaign, projecting high-intensity operations deep into September 2026. Wars of this scale, involving multi-carrier strike groups, thousands of precision munitions, massive global logistics chains, they are incredibly capital-intensive.
And how does the U.S. Treasury pay for a campaign of that magnitude when they are already running massive deficits?
They have to issue massive tranches of new sovereign debt. They sell government bonds. But here is the fatal loop. Global demand for U.S. debt is currently waning, and as we just discussed with the jobless claims, the Federal Reserve is trapped by sticky wage push inflation. They cannot lower interest rates to make the debt cheaper.
So when the Treasury issues this massive mountain of war debt and there aren't enough natural buyers, The Fed will mathematically be forced to step in as the buyer of last resort.
Yes, they will monetize the debt via balance sheet expansion.
Which is the technical term for money printing. They conjure the money to buy the government's debt.
Exactly that. Aggressive debasement of the dollar monetary base becomes an absolute mathematical certainty in order to fund the conflict. And this explains the anomaly of Bitcoin surging past $72,000 despite the restrictive labor data that would normally penalize a non-yielding asset.
Institutions are actively decoupling Bitcoin from traditional interest rate yield models.
Right. They aren't treating it as a speculative tech stock anymore. They are treating it strictly as a non-sovereign hedge against guaranteed wartime fiat debasement.
It is a profound structural enclosure. We are watching the digital asset ecosystem mature in real time under immense pressure. We have the ETFs locking down billions in institutional capital that refuses to sell. We have the actual plumbing of the federal banking system being rewired to handle instantaneous full reserve crypto settlement through entities like Kraken and Zero Hash.
And concurrently, we have a macroeconomic and geopolitical environment that practically guarantees sustained fiscal expansion and the debasement of the dollar. You are seeing a perfect storm form for the asset class.
The traditional fiduciaries see the writing on the wall, and they are moving capital defensively to prepare.
But this raises an important question, one we really need to watch closely as this conflict progresses over the coming months.
What's that?
Well, if massive institutional fiduciaries now view Bitcoin as a necessary structural hedge against sovereign debt debasement caused by geopolitical conflict, how long until the sovereign nations themselves begin quietly accumulating the asset?
Especially those nations currently observing the Middle Eastern theater of war, looking for a decentralized geopolitical shield against U.S.-centric financial sanctions.
Exactly. The game theory on a sovereign level is shifting.
That is the ultimate game theory scenario, and definitely something to keep on our radar as we monitor the movements of on-chain sovereign wallets. Thank you all for joining us for your daily briefing. We know it was a heavy stack of intel today, but navigating this level of structural change requires a deep dive into the true mechanics driving the market. We'll leave you to mull over the implications of these global shifts, and we'll be right back here with you tomorrow for your next update. Stay informed and take care.